For many years, the concept of earning a meaningful return on your safest cash savings felt like a distant memory. Savers grew accustomed to interest rates that hovered just above zero, barely making a dent in their principal balance. The idea of your money working for you, even while sitting safely in a bank, seemed to belong to a bygone era. We were told this was the new normal, a permanent feature of a slow-growth world. Many simply gave up on the idea of yield from their cash reserves, accepting that its only purpose was for immediate liquidity, not for growth or even for preserving its own value against the slow erosion of time. But in the financial world, seasons change, slowly at first, and then with gathering momentum, a shift began to occur. Now, as we navigate through 2026, a familiar and welcome number has returned to the forefront of personal finance: 5%. High-yield savings accounts are once again offering annual percentage yields, or APYs, that command attention. This isn't a promotional gimmick or a fleeting offer for a select few. It represents a fundamental change in the financial environment, a new chapter for anyone looking to make their cash work harder without venturing into the unpredictable world of stocks or other riskier assets. This return to more substantial yields is more than just a headline number. It's an opportunity. It is a chance to reevaluate how we manage the cash portion of our portfolios. The money set aside for emergencies, for a down payment on a home, or for a major purchase in the near future no longer has to sit idle. The difference between the near-zero rates of the past and the 5% rates available today is profound. It's the difference between your savings slowly losing purchasing power and your savings actively growing, outpacing inflation, and meaningfully contributing to your financial goals. It changes the calculation for savers everywhere. Understanding this shift is the first step toward taking advantage of it. This isn't about chasing fleeting trends or complex investment schemes. It's about recognizing a foundational change in the mechanics of money and making simple, prudent decisions to benefit from it. The re-emergence of the 5% savings rate is a signal, inviting us to look again at the safest corners of our financial lives and optimize them for the current reality. It offers a powerful tool for wealth preservation and steady, low-risk growth, available to anyone willing to explore the options now on the table. To understand why these attractive rates have returned, we must look to the institution at the center of the American financial system, the U.S. Federal Reserve. The Fed, as it is commonly known, wields a powerful tool called the federal funds rate. This is the interest rate at which banks lend to each other overnight, and it serves as the foundation upon which almost all other interest rates in the economy are built. When the Fed raises this target rate, borrowing becomes more expensive across the board. Conversely, when it lowers the rate, borrowing becomes cheaper, intending to stimulate economic activity. For a significant period, leading into the early 2020s, the Federal Reserve kept its key interest rate at historic lows. This was a deliberate strategy to encourage spending and investment during a time of sluggish economic growth. A direct consequence of this policy was that the rates banks offered on savings accounts also fell to near zero. For savers, this meant their cash reserves earned next to nothing. The landscape was designed for borrowers, not for those holding cash. However, as economic conditions changed, marked by rising inflation, the Federal Reserve pivoted its strategy. It embarked on a series of rate hikes, methodically increasing the federal funds rate to cool down the economy and bring inflation under control. As we stand in early 2026, the effects of this policy are clear. The Fed is now expected to hold rates steady, maintaining them at a higher level than we have seen in over a decade. This elevated rate environment has fundamentally reshaped the landscape for savers. Banks must now compete for deposits, and they do so by offering much higher yields on savings. This new, higher rate environment is the direct cause of the 5% APYs we now see on high-yield savings accounts. It is not an accident, but a direct and intended consequence of monetary policy. The same force that once pushed savings rates to the floor is now holding them at these elevated levels. Understanding this connection is crucial because it gives us confidence that these rates are not arbitrary. They are anchored to the central bank's policy, providing a stable and predictable environment for savers as we look through the coming year. Earning a 5% return on your savings is certainly an appealing prospect. But the true value of that return can only be measured when we consider another critical economic force: inflation. Inflation is the rate at which the general level of prices for goods and services is rising, and subsequently, purchasing power is falling. If your savings are earning 2%, but inflation is running at 3%, you are actually losing 1% of your money's value each year in real terms. Your account balance is growing, but its ability to buy things is shrinking. For savers, the ultimate goal is not just to see their balance increase, but to ensure their money retains or, ideally, grows its purchasing power over time. Throughout much of the last decade, with savings rates near zero and inflation at a modest but still positive 2%, savers were consistently losing ground. This reality forced many to either accept the loss or take on more risk than they were comfortable with. As of the latest reports from the end of 2025, the current inflation rate is holding steady at a more manageable 2.7%. When we compare this figure to the 5% yields now available from top high-yield savings accounts, the picture becomes much brighter. For the first time in many years, a truly safe and liquid savings vehicle offers a real yield that is substantially positive. A 5% APY, when set against 2.7% inflation, means your money's actual purchasing power is growing by approximately 2.3% each year. This positive real yield is the quiet victory for prudent savers in 2026. It means your emergency fund is not just a static pool of money, but a dynamic asset that is actively defending itself against the rising cost of living. The cash you are setting aside for a future goal is not just waiting, but growing in real terms, bringing that goal closer. This is the core reason why reevaluating your cash strategy is so critical right now. The opportunity is not simply to earn more interest, but to fundamentally protect and grow the real-world value of your hard-earned money. Navigating this new financial landscape requires a clear and steady approach. The return of attractive yields on safe assets presents a valuable opportunity, but it also brings questions. Which option is best for your specific needs? How do you choose between the various accounts available? What are the subtle but important differences between the primary vehicles for safe savings? This guide provides a calm, comprehensive roadmap to answer these questions and build a smarter cash strategy for 2026 and beyond, with no hype and no complex jargon. First, a deep dive into high-yield savings accounts, HYSAs. What a HYSA is, how a HYSA works, FDIC insurance and other protections, why some banks can offer higher rates, a clear framework for comparing the top accounts available today. Look beyond the headline, APY, fees, minimums, accessibility, real-life earnings examples to show the impact of these rates. Next, United States Treasury Bills, T-bills. T-bills are considered one of the safest investments, backed by the full faith and credit of the U.S. government. What T-bills are. How you purchase T-bills. How T-bill yields are determined. Current 3-month T-bill yields are around 3.56%. They offer unique advantages, particularly when it comes to taxes. Finally, we will bring everything together in a direct comparison. Safety, liquidity, tax efficiency, ease of use, overall returns. Based on this comparison, we'll outline simple, actionable strategies for allocating your cash based on your goals. Whether you are building an emergency fund or saving for a major purchase, we will also highlight common mistakes to avoid, ensuring your path to safer, more productive savings is smooth and secure. Our goal is to leave you with the clarity and confidence to make the best decisions for your money. At its heart, a high-yield savings account, often abbreviated as HYSA, is a simple and straightforward financial tool. It is a type of savings account that pays a significantly higher interest rate than the national average for standard savings accounts. While the core function is identical, to provide a safe place to store money you don't intend to spend immediately, the primary distinction lies in its earning potential. These accounts are designed to help your savings grow faster, turning idle cash into a productive asset. The structure of an HISA is intentionally uncomplicated. It is a deposit account held at a bank or at a credit union. You deposit your money, and in return, the institution pays you interest. This interest is expressed as annual percentage yield, or APY, which reflects the total interest you'll earn over a year, including compounding. The key differentiator: the APY on an HISA is often many times higher, sometimes 10, 20, or even more times higher than at a large traditional brick-and-mortar bank. Graphic: HISA versus traditional savings passbooks. These accounts are not investment products, they are savings products. This is a critical distinction for your financial plan. Unlike stocks, bonds, or mutual funds, the principal you deposit in an HISA is not at risk of decreasing due to market fluctuations. Your balance can only go up, driven by deposits and earned interest. This makes HISAs ideal for funds that must be kept safe and accessible: emergency fund, down payment for a house, savings for a large upcoming expense. It is a place for capital preservation and steady, predictable growth. The goal of an HISA is to provide a powerful combination of safety, accessibility, and meaningful returns. It bridges the gap between a standard checking account, which offers maximum liquidity but little to no interest, and longer-term investments, which offer higher potential returns but come with risk and less immediate access. In the current financial environment of 2026, with rates at compelling levels, the HISA has re-emerged as a foundational tool for any prudent saver. It offers a straightforward way to ensure your cash is not just sitting, but actively working to secure your financial future. When you place your hard-earned money in a savings account, your foremost concern is its safety. You need absolute certainty that your funds will be there when you need them. This is where a crucial feature of the U.S. banking system comes into play: FDIC insurance. The Federal Deposit Insurance Corporation, or FDIC, is an independent agency of the United States government that protects depositors against the loss of their insured deposits if an FDIC-insured bank or savings association fails. This protection is the bedrock of trust in the banking system and a non-negotiable feature of any legitimate high-yield savings account. FDIC insurance provides coverage up to $250,000 per depositor per insured bank for each account ownership category. This means if you have an individual account at an FDIC-insured bank, your balance is protected up to that $250,000 limit. If you have a joint account with a spouse, each of you is insured up to $250,000, providing a total of $500,000 in coverage for that account. This government guarantee ensures that even in the highly unlikely event that your bank becomes insolvent, your money is safe. It is a promise backed by the full faith and credit of the U.S. government, providing a level of security that is unparalleled in the financial world. It is essential to confirm that any bank offering a high-yield savings account is indeed FDIC insured. Reputable institutions will always display the FDIC logo prominently on their websites and in their marketing materials. You can also use the FDIC's own online tool, BankFind, to verify an institution's status. For accounts at credit unions, a similar protection exists through the National Credit Union Administration, or NCUA, which ensures deposits up to the same $250,000 limit. This layer of protection is what separates a true savings account from other financial products that may offer yield, but come with underlying risks to your principal. This government-backed insurance is what makes high-yield savings accounts one of the safest places to store your cash. It transforms a simple deposit into a secure asset, removing the risk of institutional failure from your list of concerns. This allows you to focus solely on the benefits of the account, its yield and its liquidity, with the complete peace of mind that your principal is protected. A common and logical question that arises is how certain banks can afford to offer interest rates of 5%, while others offer rates closer to zero. The answer lies in the business models of the banks themselves. The institutions that typically offer the highest yields are often online-only banks or direct banking arms of larger financial firms. These banks have a fundamentally different cost structure than traditional brick-and-mortar banks that operate vast networks of physical branches. An online bank does not have the immense overhead costs associated with real estate, branch staffing, maintenance, and security. These significant operational savings can be passed directly onto customers in the form of higher interest rates. Instead of spending money on tellers and impressive lobbies, an online bank invests in a robust digital platform and channels its resources into attracting deposits by offering more competitive yields. It is a leaner, more efficient model that is built for the digital age. This is not a sign of instability. Rather, it is a strategic business decision. They are competing for your deposits not with convenient branch locations, but with a more attractive financial return on your money. Furthermore, the core business of any bank is to take in deposits and lend that money out at a higher rate, earning a profit on the difference, which is known as the net interest margin. When the Federal Reserve raises its key interest rate, the rates at which banks can lend money also increase for mortgages, car loans, and business loans. This widens the potential profit margin for the banks. In a competitive market for deposits, banks are compelled to share a portion of this increased revenue with their customers by offering higher savings rates. Online banks, with their lower costs, are simply in a better position to offer a larger share. It is important to understand that these high yields are not a temporary gimmick or, not a too-good-to-be-true offer. They are a direct result of two powerful forces: a low-overhead business model and a high-interest rate environment shaped by Federal Reserve policy. The banks offering these rates are regulated, FDIC-insured institutions that have simply adapted their strategy to the modern financial landscape. They have identified that a compelling APY is the most effective way to attract the capital they need to operate their lending businesses, creating a symbiotic relationship that directly benefits the prudent saver. Section 4. The power of growth. How interest compounding works for you. Earning interest on your savings is the primary benefit of a high-yield savings account. But the true magic lies in compounding. Compounding is the process where you earn interest on your initial principal and on the accumulated interest from previous periods. It is interest earning interest. This creates a snowball effect, causing your savings to grow at an accelerating rate over time. While the concept is simple, its long-term impact can be incredibly powerful, turning linear growth into exponential growth. Most high-yield savings accounts compound interest on a daily basis and pay it out monthly. This is the most favorable structure for savers. Each day, the bank calculates interest on your current balance, which includes the principal and any interest credited so far. The next day, it calculates interest on that new, slightly larger balance. Daily increases may be fractions of a cent, but the cumulative effect over weeks, months, and years is substantial. Let's consider a simple illustration. If you have $10,000 in an account with a 5% APY, after 1 year, you would earn approximately $500 in interest. In the second year, you earn interest not just on your original $10,000, but on the new balance of $10,500. That equals $525 in interest in year 2 with no extra deposits. That extra $25 is the result of compounding. What seems small at first becomes powerful with larger balances and over longer time periods. That's why choosing a competitive APY and starting to save as early as possible matters. Higher rates and more time equals a stronger compounding effect. It's a patient, persistent force working in the background of your financial life. By placing funds in a high-yield savings account, you harness this principle, allowing your savings to build momentum and contribute far beyond your deposits. Section 5. Access when you need it. Understanding liquidity and transfers. A defining characteristic of any savings account, including a high-yield one, is its liquidity. Liquidity refers to how quickly and easily you can access your money without penalty or loss of principal. For funds earmarked for emergencies or for short-term goals, high liquidity is not just a convenience, it is a necessity. High-yield savings accounts provide a safe harbor for cash that stays readily available. Unlike investments that lock up money, an HISA lets you withdraw whenever you need it. Access is typically via electronic transfers. Link your HISA to an external checking account that becomes your primary hub for spending and bills. Initiate an electronic transfer. This is known as an ACH transfer. These transfers are free, They usually take 1 to 3 business days. That delay matters for planning. Initiate transfers a few days before you need funds. Be aware of Regulation D. It historically limited certain transfers to 6 per month. The rule was revised, but some banks still set their own limits. Read the account terms to confirm any restrictions. Transfers to a linked checking account are typically unlimited. Verify your bank's specific policies. Liquidity, combined with a strong yield, is what makes HISAs versatile, perfect for an emergency fund. Emergency funds must be safe and accessible at a moment's notice, also ideal for specific goals like a wedding or a car purchase. Grow your money while keeping it available. They balance earning a return with providing access, which gives you growth and flexibility. Section 6. The fine print. Navigating fees and minimums. While the headline APY is the most attractive feature, it's essential to look beyond that number. Fees, minimum balance requirements. The best high-yield savings accounts distinguish themselves by having no monthly maintenance fees and no minimum balance requirements to earn the advertised APY. This is a crucial feature, as fees can quickly erode the interest you earn, diminishing the primary advantage of the account. An account that charges a $10 monthly fee, for example, would require a balance of $2,400 just to break even at a 5% APY. When evaluating an account, comb through the fee schedule carefully. Look for any potential charges, such as fees for excessive transactions, wire transfers, paper statements. A truly top-tier HISA will be transparent and keep these incidental fees to a minimum or eliminate them entirely. The absence of a monthly maintenance fee is particularly important, as it ensures that every dollar of interest you earn is yours to keep. Similarly, pay close attention to any minimum deposit or balance requirements. Many of the leading HISAs allow you to open an account with as little as $1 and have no ongoing minimum balance you must maintain. This makes them accessible to everyone, regardless of how much you are starting with. Other accounts might require a minimum opening deposit, such as $100, or may have tiered interest rates, where you need to maintain a certain balance, say $25,000 or more, to qualify for the highest advertised APY. Be sure you understand these tiers and can comfortably meet the requirements for the rate you expect to receive. Ultimately, the goal is to find an account where the terms work for you, not against you. The ideal high-yield savings account combines a top-tier APY with a fee-free structure and no minimum balance requirements. This combination ensures that the account is both profitable and flexible, allowing you to save on your own terms without worrying about hidden costs or arbitrary rules that could undermine your progress. Taking a few extra minutes to read the fine print before opening an account is a small investment of time that can pay significant dividends in the long run. In an era where nearly every aspect of our lives is managed through a screen, the quality of a bank's digital platform is paramount. For online banks that offer high-yield savings accounts, their mobile app and website are their primary, and often only, branches. Therefore, the user experience of these digital tools is not just a matter of convenience, it is a core component of the bank's service. A well-designed platform can make managing your savings a seamless and even enjoyable process, while a clunky or unreliable one can create frustration and friction. A top-quality digital banking experience should be clean, intuitive, and secure. When you log in, you should be able to see your account balance, recent transaction history, and interest earned at a glance. Initiating transfers to and from your linked external accounts should be a straightforward process that takes only a few taps or clicks. Modern features like mobile check deposit add another layer of convenience. Taking a picture of a check with your phone, deposit confirmation. Security is another critical aspect of digital access. Reputable banks invest heavily in robust security measures to protect your information and your money. This includes features like multi-factor authentication, which requires a second form of verification in addition to your password, such as a code sent to your phone. Biometric login options, using your fingerprint or face identification, also provide a convenient and highly secure way to access your account. These features should give you confidence that your funds are not only protected by FDIC insurance, but also shielded from unauthorized digital access. The quality of a bank's digital tools can be a significant differentiating factor when choosing between two accounts with similar APYs and fee structures. Before committing to an account, it can be helpful to read reviews of the bank's mobile app in the Apple App Store or Google Play Store. Look for comments on ease of use, reliability, and the availability of key features. A bank that has clearly invested in creating a polished and user-friendly digital experience is often one that is committed to providing excellent customer service overall, making them a better long-term partner for your savings journey. While both are savings accounts, the difference between a high-yield savings account and a traditional savings account from a large national brick-and-mortar bank is stark. The most obvious and impactful distinction is the interest rate. As of early 2026, top HISAs are offering APYs around 5%, while the national average for traditional savings accounts languishes at approximately 0.45%. This is not a small gap. It is a difference of more than tenfold. On a $10,000 balance, this is the difference between earning around $500 per year versus earning just $45. Over time, this vast disparity in earning potential can have a profound impact on your ability to reach your financial goals. This difference in yield is rooted in the divergent business models we discussed earlier. Traditional banks support extensive and expensive physical infrastructures, thousands of branches, ATMs in prime locations, large numbers of employees. They rely on their established brand presence, convenience, and a wide array of bundled services to retain customers, rather than competing primarily on the rate paid for savings. In contrast, HISAs are typically offered by online-first institutions that have eliminated the costs of running a physical branch network. Their streamlined, digital-native model allows them to operate more efficiently and pass those savings on to you in the form of a higher APY. The trade-off, historically, has been in-person service. With a traditional bank, you can walk into a branch and speak with a teller or a banker face-to-face. With an online bank, customer service is handled via phone, secure messaging, or online chat. For many, this is a more than acceptable trade-off for a significantly higher return, especially for a simple savings account that requires infrequent interaction. When exploring options for high-yield savings, you'll likely also encounter another product, the money market account, also called an MMA. Money market accounts are a type of FDIC-insured deposit account. They often pay higher interest than traditional savings accounts. They are very similar to HISAs. Both provide a safe place to store cash while earning a competitive yield. However, there are a few subtle but important differences in their features and functionality. It's worth understanding those before deciding where to park your cash. Historically, the key distinguishing feature was check writing privileges, and sometimes a debit card. That made MMAs a hybrid between savings and checking. That convenience lets you access emergency funds directly without transferring first. That flexibility is the primary reason to choose an MMA over an HISA, but that convenience can come at a cost. MMAs have competitive rates versus traditional savings, but can be slightly lower than the absolute highest rates from top online HISAs. MMAs often carry higher minimum deposit and balance requirements than HISAs. Today, the lines between HISAs and MMAs are increasingly blurred. Some HISAs now offer ATM cards for easier access, and yields on both account types are often very close. Evaluate each account on its individual merits, not just the label. Compare the APY, compare the fees, compare minimum balance requirements, compare access features like check writing, and compare debit card access. For most people aiming to maximize returns while keeping cash safe, a leading high-yield savings account will often be the most straightforward and profitable choice. Choosing the right high-yield savings account is a personal decision, one that extends beyond simply chasing the highest advertised interest rate. To make an informed choice that aligns with your financial habits and goals, it is essential to establish a clear framework for evaluation. This framework acts as your personal checklist, ensuring you consider all the crucial aspects of an account before committing your funds. The primary criteria should include the annual percentage yield, the fee structure, minimum balance requirements, the quality of digital tools, customer service availability and quality, and the speed and flexibility of money transfers. By systematically assessing each potential account against these pillars, you can move from being a passive rate taker to an active, educated consumer. Think of this process as being similar to purchasing any other significant product or service. You wouldn't buy a car based solely on its top speed. You would also consider its safety ratings, fuel efficiency, reliability, and comfort. Similarly, the best high-yield savings account for you is not necessarily the one with the flashiest APY, but the one that offers the best overall value and fits most seamlessly into your life. For instance, a saver who values immediate assistance might prioritize a bank known for its 24/7 phone support, even if its APY is a few hundredths of a percent lower than a competitor with more limited service hours. Establishing your personal priorities up front is the key to navigating the competitive landscape effectively. Your framework should be a practical guide. Start by listing the features that are non-negotiable for you. For many, this will be FDIC insurance and the absence of monthly maintenance fees. From there, rank the remaining criteria in order of importance. Is maximizing every possible basis point of yield your top priority? Or is the convenience of a highly rated mobile app and fast transfer times more critical for your peace of mind? Perhaps you are starting with a small amount of savings, making an account with no minimum deposit requirement an absolute necessity. This personalized hierarchy will serve as your compass, guiding you toward the account that is truly the best fit. Ultimately, this structured approach demystifies the selection process. It prevents you from being swayed by clever marketing and focuses your attention on the substantive features that will impact your savings journey day in and day out. As we delve deeper into each of these criteria in the following sections, you can use this framework to build a comprehensive picture of what a perfect high-yield savings account looks like for your specific situation. This empowers you to compare different offerings not just against each other, but against a clear, personalized standard of excellence, ensuring the account you choose is a true asset to your financial plan. Section 1. Bringing the numbers to life. The power of concrete examples. Theory and percentages are essential for understanding high-yield savings accounts. But the true impact only becomes clear when we apply them to real-life scenarios. Abstract concepts like a 5% APY or daily compounding can feel distant until we translate them into tangible dollar amounts. By walking through concrete examples with specific deposit balances and timeframes, we can bridge the gap between financial theory and financial reality. Section 2. The starting point. Earning on a $5,000 emergency fund. Let's begin with one of the most fundamental building blocks of personal finance: the emergency fund. For our first example, we will use a starting balance of $5,000. This is a common and commendable goal for individuals and families looking to create a buffer against unexpected life events, a car repair, a medical bill, a temporary loss of income. The primary purpose of this money is safety and accessibility. But in the current environment, there is no reason it shouldn't also be growing. Placing this $5,000 in a high-yield savings account transforms it from a static safety net into a dynamic asset that works for you even while it waits. For many years, the earnings on a fund of this size were negligible. In a traditional savings account paying a mere 0.45% APY, a $5,000 balance would earn only about $20 over the course of an entire year. This reality led many to feel that the effort of seeking out a better rate for a smaller balance simply wasn't worth it. The return was so minimal that it hardly seemed to matter, leading to widespread inertia and a missed opportunity for growth, however small. This is the mindset that the new rate environment is here to change. The return of higher yields has completely altered the calculation for a $5,000 emergency fund. The growth potential is no longer trivial. It is meaningful. Earning a competitive rate on these funds provides a small but steady tailwind, helping your savings grow faster and better, protecting its purchasing power against inflation. Each dollar of interest earned is a dollar you did not have to save yourself, adding to your security cushion without any additional effort on your part. This passive growth can make a real psychological difference, providing a sense of progress and reinforcing positive savings habits as you watch your balance climb month after month. In the following sections, we will break down exactly what this growth looks like at different APYs. We will quantify the interest earned over 1 year at 3%, 4%, 5%. This will provide a clear side-by-side comparison that demonstrates just how much of a difference your choice of account can make, even with a starting balance of $5,000. The numbers will show that taking a few minutes to open the right account is one of the highest return activities you can undertake for your financial well-being, turning a simple emergency fund into a source of quiet, consistent growth. Now let's scale up our example to a more substantial principle of $50,000. A down payment for a first home, a fund for a child's future education, a major home renovation project, a larger emergency fund. When dealing with a balance of this size, the impact of different interest rates becomes far more dramatic. The small percentage differences we saw with a $5,000 balance now translate into thousands of dollars. The stakes are 10 times higher. Let's rerun our comparison with this new principle. In a traditional savings account paying 0.45%, a $50,000 balance would earn a meager $225 over the year. In our baseline high-yield scenario with a 3% APY, that same $50,000 would earn $1,500. Stepping up to a 4% APY, the annual earnings jump to $2,000. And at the top-tier 5% APY, the account would generate $2,500 in interest in a single year. Table graphic: annual earnings on $50,000, 3,000%, 1,500, 4,000%, 2,000, 5,000%, $2,500. The difference between the bottom-rung high-yield savings account and the top-tier one is now $1,000 annually. This $1,000 difference is not an abstract number, it is real money. For someone saving for a down payment, an extra $1,000 a year could mean reaching their goal months sooner. For a retiree with this money set aside for living expenses, it could cover a month's worth of groceries or a utility bill. This is the opportunity cost of complacency. By settling for a 3% rate when a 5% rate is available, you are effectively choosing to forgo $1,000 of effortless, risk-free income each year. This makes the case for optimization overwhelmingly powerful. Furthermore, earning $2,500 in interest on a $50,000 principal represents a significant acceleration of your savings plan. It is the equivalent of saving an extra $208 every month without having to pull it from your budget. This passive income stream works in the background, supplementing your own contributions and helping you build wealth faster. When dealing with larger sums of money, the imperative to find the best possible rate is no longer a matter of small optimizations. It becomes a core component of a smart financial strategy with a major impact on your bottom line. Thus far, our journey into safer savings has focused on high-yield savings accounts, a powerful tool offered by banks. Now, we turn our attention to another formidable instrument, one that comes not from a private institution, but directly from the United States government. The Treasury Bill, or T-bill. These are short-term debt securities issued by the United States Department of the Treasury to fund its day-to-day operations. When you buy a T-bill, you are in essence lending money to the United States government for a specified period. In return for this loan, the government promises to pay you back the full amount at the end of that period, and you earn interest for your service. T-bills are a cornerstone of the global financial system, widely regarded as one of the safest investments on the planet. They belong to a family of government securities that also includes Treasury notes and Treasury bonds, which have longer durations. T-bills specifically represent the shortest-term borrowings, with maturities of 1 year or less. This short-term nature makes them an excellent vehicle for cash management, similar in purpose to a high-yield savings account. Structure, risk profile, tax treatment. Understanding T-bills gives you another powerful option for optimizing the cash portion of your portfolio, providing a compelling alternative or complement to a bank-based savings strategy. Throughout this guide, We have explored two of the most powerful instruments for safe savings in 2026, the high-yield savings account and the U.S. Treasury bill. Both offer a compelling combination of security and return, far surpassing traditional savings vehicles. Now it is time to bring them together for a final, direct comparison across the key dimensions that matter most to a saver. By laying their strengths and weaknesses side by side, we can create a clear decision-making framework. The primary factors for our showdown are safety, liquidity, tax efficiency, ease of use, and potential return on your money. This direct comparison will serve as the foundation for building a truly smart cash strategy. On the measure of safety, both instruments are top-tier, but with a subtle distinction. HISAs are protected by FDIC insurance, which guarantees your deposits up to $250,000 per depositor per bank. This is an incredibly robust protection for the vast majority of savers. T-bills, however, are backed by the full faith and credit of the U.S. government, a guarantee considered the absolute benchmark for risk-free assets globally. For sums exceeding the FDIC limit, or for those seeking the highest possible level of security, T-bills hold a slight theoretical edge. For most practical purposes and balances, however, both can be considered exceptionally safe havens for your capital. When it comes to liquidity, the high-yield savings account is the clear winner for on-demand access. Transferring funds from an HISA to a linked checking account typically takes 1 to 3 business days, providing a high degree of flexibility for unexpected expenses. While T-bills purchased through a brokerage can be sold on the secondary market before maturity, this process is slightly more complex and involves minor price risk based on prevailing interest rates. T-bills are designed with a fixed term in mind, making HISAs the superior choice for funds where immediate, penalty-free access is the highest priority, such as a primary emergency fund that needs to be available at a moment's notice. For ease of use, the HISA also generally comes out ahead. Opening and managing a high-yield savings account is a simple, intuitive process, familiar to anyone who has ever used online banking. The variable rate adjusts automatically, requiring no active management from the saver. T-bills involve a slightly steeper learning curve, auction process, discount pricing, fixed maturities. While platforms like Treasury Direct and modern brokerages have simplified the process immensely, it still requires a more hands-on approach than the passive nature of an HISA. The HISA offers simplicity, while the T-bill offers more granular control for the more engaged saver. Section 2. The right tool for the right job. Allocating by financial goal. The conclusion from our head-to-head comparison is not that one instrument is definitively better, but that each is a specialized tool with unique strengths. The truly smart cash strategy for 2026 does not involve an exclusive choice between HISAs and T-bills. Instead, it involves using the right tool for the right job. By aligning the specific features of each instrument with your distinct financial goals, you can construct a comprehensive cash management system that is optimized for safety, return, and flexibility. This approach moves beyond a simple either-or debate and into a more sophisticated both-and strategy. Your financial goals can be broadly categorized by their time horizon and liquidity needs. First, emergency fund. Second, short-term savings goals. Finally, a larger pool of cash as a strategic reserve or stable portion of a long-term portfolio. Emergency fund must be supremely liquid and accessible for unpredictable, urgent expenses. Emergency fund drawer contains HISA. Primary requirements are safety and immediate liquidity. The ability to access your money quickly and without penalty in a crisis outweighs the benefit of a slightly higher tax-adjusted yield or a locked-in rate. The high-yield savings account, with its simple electronic transfers and no fixed term, is almost perfectly designed for this purpose. It provides the necessary flexibility while still offering a competitive return that protects purchasing power against inflation. This makes the HISA the foundational tool for your most immediate financial safety net, providing both security and accessibility. For your defined short-term savings goals, the calculation changes. Here, you have a known timeline. Example, down payment on a car. Example, a wedding. Example, a home. Savings goals drawer contains mix of HISAs and T-bills. If you are saving for a down payment in 6 months, the predictability of a T-bill becomes highly attractive. You can purchase a 6-month T-bill, lock in a specific rate of return, and know the exact amount will be available on the exact date you need it. This eliminates the risk of the variable rate on an HISA decreasing before your goal is reached. T-bills or a ladder of T-bills are ideal for planned objectives, offering precision and control. That's the gist. Section 5. Common mistakes to avoid on your savings journey. As you embark on your journey to optimize your cash savings, awareness of common pitfalls can help you navigate more smoothly and avoid costly errors. The first and most pervasive mistake is inertia. Many people know their money is languishing in a low-yield traditional savings account, but delay taking action because the process seems daunting. As our examples have shown, this inaction has a real, quantifiable cost that can amount to thousands of dollars over time. Overcoming this inertia and taking the 1 or 2 hours needed to open a better account is the single most important step you can take. A second common mistake is focusing exclusively on the headline APY while ignoring other crucial factors. As we have detailed, an account with a slightly lower APY but no monthly fees, a superior mobile app, and excellent customer service may be a far better choice than a marginally higher rate account that is difficult to use or has a poor support system. Similarly, savers in high-tax states who ignore the tax-equivalent yield of T-bills may be leaving significant money on the table. A holistic evaluation that considers all aspects of the account and your personal situation is essential for making a truly optimal choice. A third critical error is poor liquidity planning. This can happen in 2 ways. Some savers keep far too much cash in a zero-interest checking account out of an unfounded fear that HISA or T-bill funds are not accessible enough. Conversely, a saver might put all their emergency funds into a 1-year T-bill without considering they might need the cash in 3 months, forcing a potential sale on the secondary market. A balanced approach, like keeping a small buffer in checking and the rest in a liquid HISA, is the prudent path. Finally, a frequent oversight is failing to monitor and manage FDIC insurance limits. If your cash savings at a single bank exceed the $250,000 per depositor limit, the excess funds are not insured. For those with larger cash balances, it is crucial to either spread the money across multiple banking institutions to ensure full coverage or to utilize U.S. Treasury bills, which have no practical limit on their government backing. Section 6. Final thoughts. A calm and confident path forward in 2026. We have covered a great deal of ground, from the macroeconomic forces driving interest rates to the practical, step-by-step details of opening an account. Our journey through high-yield savings accounts and U.S. Treasury bills has illuminated a clear and powerful opportunity for savers in 2026. The return of meaningful yield on safe assets is not a fleeting trend, but a fundamental shift in the financial landscape. It represents an invitation to re-engage with the cash portion of your portfolio and transform it from an idle, depreciating asset into a productive and resilient one that actively contributes to your financial well-being. The path forward does not require complex financial engineering or taking on undue risk. The beauty of the strategies we have discussed lies in their simplicity and security. The core actions are straightforward. Move your primary savings from a low-yield account to a top-tier, fee-free high-yield savings account. For larger, time-bound goals, consider the unique benefits of T-bills to lock in rates and gain tax advantages. And for all your savings, be disciplined and consistent. These are not revolutionary ideas, but timeless principles of prudent financial management that are now supercharged by a favorable interest rate environment. The ultimate goal of this guide is to replace financial anxiety with a sense of calm confidence. By understanding how these tools work and how they fit into your personal financial picture, you can feel empowered to make deliberate, informed decisions. You can build a cash strategy that not only grows your wealth, but also provides a durable foundation of security, allowing you to weather any economic storm and pursue your life's goals with greater peace of mind. The knowledge you have gained provides you with a clear roadmap to a more secure and prosperous financial future. Therefore, the final step is to take action. Use the frameworks we have provided to evaluate your options. Choose the accounts and strategies that best align with your goals and your life. The opportunity to earn a safe, substantial return on your cash is here. By embracing it with clarity and purpose, you can ensure that as you navigate the year ahead, your money is working just as hard for you as you work to earn it. The path to smarter, safer savings is clear, and it is yours to walk with confidence.